Most people know something about the stock market, but many investors who see stock as a way to get rich quick might not understand exactly what stock is and how it works. Before jumping feet first into investing in stocks, it is important to understand some of the basics and the risks involved in owning stocks. A company can raise money by going public and selling a portion of the company by issuing stock. This is called equity financing. The advantage to the company is that it doesn't have to pay back the money or pay interest right away, as it would to a bank if it borrowed the money it needed. The advantage to the shareholder is the potential to make money through dividends and/or capital appreciation. Dividends are taxable payments to shareholders from the company's earnings. They are generally paid quarterly in cash, but there is no guarantee that dividends will continue to be paid. Capital appreciation is the difference between the amount paid for a stock and its current value. Shareholders also have the ability to trade their stocks on an exchange at any time. Stock is quite simply a share in the ownership of a company, which is why stockholders are called shareholders. When you buy stock, you are actually buying a piece of the company it represents. You have a claim on part of the corporation's assets and earnings. As a partial owner of the company, you therefore take on the potential risks and benefits of that position, but you don't have to put any effort into running it. Your ownership is determined by the number of shares you own divided by the total number of shares sold by the company. For example, if a company has issued 1,000 shares and you have 10, you own 1% of the company. Of course, if you own 10 shares of a large company that has issued millions of shares, your equity in the company is quite small. If a company is profitable, it may decide to pay dividends to shareholders from its earnings. On the other hand, some companies may decide to reinvest profits back into their businesses rather than pay dividends. Investors have the potential to make money from dividends as well as from appreciation in the value of stock shares on the open market. Thus, stockholders have the potential to make money if the company does well and the potential to lose money if the company does poorly. The return and principal value of stocks fluctuate with changes in market conditions. Shares, when sold, may be worth more or less than their original cost. Shareholders of common stock often have voting rights on major issues at annual meetings, usually electing a board of directors. In this way, shareholders have a say in the way the company is run. Owners of preferred stock usually don't have voting rights but have a higher claim on the company's assets and earnings than common stockholders do. If a company pays dividends, preferred stockholders receive theirs before common stockholders. There is always a risk when investing in stocks. How does the stock market work? You may have heard that investing in stocks can be a great way to create wealth over time, and it's certainly true. But do you really know how the stock market works? Or what makes a stock market different from a stock exchange or stock index? Do you know what a stock is? If you're curious, here's a rundown of the basics of stock markets, stock exchanges, and stock indexes. How does the stock market work? Before we can get into stock markets, you need to understand stocks and how they work on a basic level. So how does the stock market work? Stock markets facilitate the sale and purchase of these stocks between individual investors, institutional investors, and companies. The vast majority of stock trades take place between investors. That means, for example, that if you want to buy shares of Microsoft and hit the Buy button through your broker's website, you are buying shares that another investor has decided to sell, not from Microsoft itself. By purchasing shares of a stock, you become an investor in the underlying company. How are prices determined on a stock market? Stock prices on exchanges are governed by supply and demand, plain and simple. At any given time, there's a maximum price someone is willing to pay for a certain stock and a minimum price someone else is willing to sell shares of the stock for. Think of stock market trading like an auction, with some investors bidding for the stocks that other investors are willing to sell. If there is a lot of demand for a stock, investors will buy shares quicker than sellers want to get rid of them, and the price will move higher. On the other hand, if more investors are selling a stock than buying, the market price will drop. Taking it a step further, it's important to consider how it's possible to always buy or sell a stock you own. And that's where market makers come in. Market makers ensure there are always buyers and sellers. To make sure there's always a marketplace for stocks on an exchange and investors can choose to buy and sell shares immediately whenever they want to during market hours, individuals known as market makers act as intermediaries between buyers and sellers. Here's a rundown of what investors should know about the process. Market makers buy and hold shares and continually list buy and sell quotations for shares. The highest offer to buy shares listed from a market maker at any given time is known as the bid, and the lowest offered selling price is known as the ask. The difference between the two is called the spread. The main reason for using the market maker system as opposed to simply letting investors buy and sell shares directly to one another is to be sure there is always a buyer to match with every seller and vice versa. If you want to sell a stock, you don't need to wait until a buyer wants your exact number of shares. A market maker will buy them right away. What happens when you buy a stock? Investors must carry out the transactions of buying or selling stocks through a broker, which is simply an entity licensed to trade stocks on a stock exchange. A broker may be an actual person whom you tell what to buy and sell, or, more commonly, this can be an online broker, say, TD Ameritrade or Fidelity, that processes the entire transaction electronically. When you buy a stock, here's the simplified version of how it works. You tell your broker, or input electronically, what stock you want to buy and how many shares you want. Your broker relays your order to the exchange, and a market maker sells you shares at the current market price. The shares are then delivered to your account. How does a stock index track the stock market? You've probably heard statements such as, the market is up, or that a stock beat the market. Often when discussing the stock market, people generalize the market to a stock index. Stock indexes, such as the S&P 500 or the Dow Jones Industrial Average, are a representation of the performance of a large group of stocks, but often not an entire stock exchange, and are used as a benchmark to compare the performance of individual stocks or an entire portfolio. For example, the S&P 500 index tracks the performance of 500 of the largest publicly traded companies in the US. Indexes are a convenient way to discuss an approximation of what is happening in the market, but it's important to understand that the major stock indexes you see on TV and in the news do not fully represent the entire stock market. Stock markets, stock exchanges, and stock indexes. There are three different terms here with similar and often misunderstood meanings. A stock market refers to the process and facilitation of investors buying and selling stocks with one another. A stock exchange is the actual intermediary that connects buyers with sellers, such as the New York Stock Exchange, NYSE. A stock index is a numerical representation of a group of stocks that is used to track their collective performance. Understanding the investment risk ladder. Here are the major asset classes, in ascending order of risk, on the investment risk ladder. Cash. A cash bank deposit is the simplest, most easily understandable investment asset, and the safest. Not only does it give investors precise knowledge of the interest they'll earn, but it also guarantees they'll get their capital back. On the downside, the interest earned from cash socked away in a savings account seldom beats inflation. Certificates of deposit are highly liquid instruments, very similar to cash that are instruments that typically provide higher interest rates than those in savings accounts. However, money is locked up for a period of time and there are potential early withdrawal penalties involved. Bonds. A bond is a debt instrument representing a loan made by an investor to a borrower. A typical bond will involve either a corporation or a government agency, where the borrower will issue a fixed interest rate to the lender in exchange for using their capital. Bonds are commonplace in organizations that use them in order to finance operations, purchases, or other projects. Bond rates are essentially determined by the interest rates. Due to this, they are heavily traded during periods of quantitative easing or when the Federal Reserve, or other central banks, raise interest rates. A beginner's guide to asset classes. The investment landscape can be extremely dynamic and ever-evolving. But those who take the time to understand the basic principles and the different asset classes stand to gain significantly over the long haul. The first step is learning to distinguish different types of investments and what rung each occupies on the risk ladder. Key takeaways. Investing can be a daunting prospect for beginners, with an enormous variety of possible assets to add to a portfolio. The investment risk ladder identifies asset classes based on their relative riskiness, with cash being the most stable and alternative investments often being the most volatile. Sticking with index funds or exchange-traded funds that mirror the market is often the best path for a new investor. Understanding the investment risk ladder. Here are the major asset classes, in ascending order of risk, on the investment risk ladder. Cash. A cash bank deposit is the simplest, most easily understandable investment asset, and the safest. Not only does it give investors precise knowledge of the interest they'll earn, but it also guarantees they'll get their capital back. On the downside, the interest earned from cash socked away in a savings account seldom beats inflation. Certificates of deposit, CDS, are highly liquid instruments, very similar to cash that are instruments that typically provide higher interest rates than those in savings accounts. However, money is locked up for a period of time and there are potential early withdrawal penalties involved. Bonds. A bond is a debt instrument representing a loan made by an investor to a borrower. A typical bond will involve either a corporation or a government agency, where the borrower will issue a fixed interest rate to the lender in exchange for using their capital. Bonds are commonplace in organizations that use them in order to finance operations, purchases, or other projects. Bond rates are essentially determined by the interest rates. Due to this, they are heavily traded during periods of quantitative easing or when the Federal Reserve or other central banks raise interest rates. Mutual funds. A mutual fund is a type of investment where more than one investor pools their money together in order to purchase securities. Mutual funds are not necessarily passive, as they are managed by portfolio managers who allocate and distribute the pooled investment into stocks, bonds, and other securities. Individuals may invest in mutual funds for as little as $1,000 per share, letting them diversify into as many as 100 different stocks contained within a given portfolio. Mutual funds are sometimes designed to mimic underlying indexes such as the S&P 500 or Dow Industrial Index. There are also many mutual funds that are actively managed, meaning they are updated by portfolio managers who carefully track and adjust their allocations within the fund. However, these funds generally have greater costs, such as yearly management fees and front-end charges, which can cut into an investor's returns. Mutual funds are valued at the end of the trading day, and all buy and sell transactions are likewise executed after the market closes. Point 4. Exchange-traded funds. Exchange-traded funds have become quite popular since their introduction back in the mid-1990s. ETFs are similar to mutual funds, but they trade throughout the day on a stock exchange. In this way, they mirror the buy and sell behavior of stocks. This also means their value can change drastically during the course of a trading day. ETFs can track an underlying index such as the S&P 500 or any other basket of stocks the issuer of the ETF wants to underline a specific ETF with. This can include anything from emerging markets, commodities, individual business sectors such as biotechnology or agriculture, and more. Due to the ease of trading and broad coverage, ETFs are extremely popular with investors. Stocks. Shares of stock let investors participate in the company's success via increases in the stock's price and through dividends. Shareholders have a claim on the company's assets in the event of liquidation, that is, the company going bankrupt, but do not own the assets. Holders of common stock enjoy voting rights at shareholders' meetings. Holders of preferred stock don't have voting rights but do receive preference over common shareholders in terms of the dividend payments. Alternative investments. There is a vast universe of alternative investments, including the following sectors. Real estate. Investors can acquire real estate by directly buying commercial or residential properties. Alternatively, they can purchase shares in real estate investment trusts, REITs. REITs act like mutual funds wherein a group of investors pool their money together to purchase properties. They trade like stocks on the same exchange. Hedge funds and private equity funds. Hedge funds, which may invest in a spectrum of assets designed to deliver beyond market returns, called alpha. However, performance is not guaranteed, and hedge funds can see incredible shifts in returns, sometimes underperforming the market by a significant margin. Typically only available to accredited investors, these vehicles often require high initial investments of $1 million or more. They also tend to impose net worth requirements. Both investment types may tie up an investor's money for substantial time periods. Commodities. Commodities refer to tangible resources such as gold, silver, crude oil, as well as agricultural products. How to invest sensibly, suitably, and simply. Many veteran investors diversify their portfolios using the asset classes listed above, with a mix reflecting their tolerance for risk. A good piece of advice to investors is to start with simple investments, then incrementally expand their portfolios. Specifically, mutual funds or ETFs are a good first step before moving on to individual stocks, real estate, and other alternative investments. However, most people are too busy to worry about monitoring their portfolios on a daily basis. Therefore, sticking with index funds that mirror the market is a viable solution. Stephen Goldberg, a principal at the firm Tweddle Goldberg Investment Management and longtime mutual funds columnist at Kiplinger.com, further argues that most individuals only need 3 index funds, one covering the US equity market, another with international equities, and the third tracking a bond index. The bottom line: investment education is essential, as is avoiding investments you don't fully understand. Rely on sound recommendations from experienced investors, while dismissing hot tips from untrustworthy sources. When consulting professionals, look to independent financial advisors who get paid only for their time, instead of those who collect commissions. And above all, diversify your holdings across a wide swath of assets. What is a bond? A bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. A bond could be thought of as an IOU between the lender and borrower that includes the details of the loan and its payments. Bonds are used by companies, municipalities, states, and sovereign governments to finance projects and operations. Owners of bonds are debt holders or creditors of the issuer. Bond details include the end date when the principal of the loan is due to be paid to the bond owner and usually include the terms for variable or fixed interest payments made by the borrower. The issuers of bonds. Governments, at all levels, and corporations commonly use bonds in order to borrow money. Governments need to fund roads, schools, dams, or other infrastructure. The sudden expense of war may also demand the need to raise funds. Similarly, corporations will often borrow to grow their business, to buy property and equipment, to undertake profitable projects, for research and development, or to hire employees. The problem that large organizations run into is that they typically need far more money than the average bank can provide. Bonds provide a solution by allowing many individual investors to assume the role of the lender. Indeed, public debt markets let thousands of investors each lend a portion of the capital needed. Moreover, markets allow lenders to sell their bonds to other investors or to buy bonds from other individuals, long after the original issuing organization raised capital. How bonds work. Bonds are commonly referred to as fixed income securities and are one of main asset classes that individual investors are usually familiar with, along with stocks, equities, and cash equivalents. Many corporate and government bonds are publicly traded, others are traded only over the counter or privately between the borrower and lender. When companies or other entities need to raise money to finance new projects, maintain ongoing operations, or refinance existing debts, they may issue bonds directly to investors. The borrower, issuer, issues a bond that includes the terms of the loan, interest payments that will be made, and the time at which the loaned funds, bond principal, must be paid back, maturity date. The interest payment, the coupon, is part of the return that bondholders earn for loaning their funds to the issuer. The interest rate that determines the payment is called the coupon rate. The initial price of most bonds is typically set at par, usually $100 or $1,000 face value per individual bond. The actual market price of a bond depends on a number of factors: the credit quality of the issuer, the length of time until expiration, and the coupon rate compared to the general interest rate environment at the time. The face value of the bond is what will be paid back to the borrower once the bond matures. Most bonds can be sold by the initial bondholder to other investors after they have been issued. In other words, a bond investor does not have to hold a bond all the way through to its maturity date. It is also common for bonds to be repurchased by the borrower if interest rates decline, or if the borrower's credit has improved, and it can reissue new bonds at a lower cost. Characteristics of bonds. Most bonds share some common basic characteristics, including: face value is the money amount the bond will be worth at maturity. It is also the reference amount the bond issuer uses when calculating interest payments. For example, say an investor purchases a bond at a premium $1,090 and another investor buys the same bond later when it is trading at a discount for $980. When the bond matures, both investors will receive the $1,000 face value of the bond. The coupon rate is the rate of interest the bond issuer will pay on the face value of the bond, expressed as a percentage. For example, a 5% coupon rate means that bondholders will receive 5% x $1,000 face value equals $50 every year. Coupon dates are the dates on which the bond issuer will make interest payments. Payments can be made in any interval, but the standard is semi-annual payments. The maturity date is the date on which the bond will mature, and the bond issuer will pay the bondholder the face value of the bond. The issue price is the price at which the bond issuer originally sells the bonds. Two features of a bond, credit quality and time to maturity, are the principal determinant of a bond's coupon rate. If the issuer has a poor credit rating, the risk of default is greater, and these bonds pay more interest. Bonds that have a very long maturity date also usually pay a higher interest rate. This higher compensation is because the bondholder is more exposed to interest rate and inflation risks for an extended period. Credit ratings for a company and its bonds are generated by credit rating agencies like Standard & Poor's, Moody's, and Fitch Ratings. The very highest quality bonds are called investment grade and include debt issued by the US government and very stable companies, like many utilities. Bonds that are not considered investment grade, but are not in default, are called high yield or junk bonds. These bonds have a higher risk of default in the future, and investors demand a higher coupon payment to compensate them for that risk. Bonds and bond portfolios will rise or fall in value as interest rates change. The sensitivity to changes in the interest rate environment is called duration. The use of the term duration in this context can be confusing to new bond investors because it does not refer to the length of time the bond has before maturity. Instead, duration describes how much a bond's price will rise or fall with a change in interest rates. The rate of change of a bond's or bond portfolio's sensitivity to interest rates, duration, is called convexity. These factors are difficult to calculate, and the analysis required is usually done by professionals. Categories of bonds. There are 4 primary categories of bonds sold in the markets. However, you may also see foreign bonds issued by corporations and governments on some platforms. Corporate bonds are issued by companies. Companies issue bonds rather than seek bank loans for debt financing in many cases because bond markets offer more favorable terms and lower interest rates. Municipal bonds are issued by states and municipalities. Some municipal bonds offer tax-free coupon income for investors. Government bonds such as those issued by the US Treasury. Bonds issued by the Treasury with a year or less to maturity are called bills. Bonds issued with 1 to 10 years to maturity are called notes, and bonds issued with more than 10 years to maturity are called bonds. The entire category of bonds issued by a government treasury is often collectively referred to as treasuries. Government bonds issued by national governments may be referred to as sovereign debt. Agency bonds are those issued by government-affiliated organizations such as Fannie Mae or Freddie Mac. Varieties of bonds. The bonds available for investors come in many different varieties. They can be separated by the rate or type of interest or coupon payment, being recalled by the issuer, or have other attributes. Zero coupon bonds. Zero coupon bonds do not pay coupon payments and instead are issued at a discount to their par value that will generate a return once the bondholder is paid the full face value when the bond matures. US Treasury bills are a zero coupon bond. Convertible bonds. Convertible bonds are debt instruments with an embedded option that allows bondholders to convert their debt into stock, equity, at some point, depending on certain conditions like the share price. For example, imagine a company that needs to borrow $1 million to fund a new project. They could borrow by issuing bonds with a 12% coupon that matures in 10 years. However, if they knew that there were some investors willing to buy bonds with an 8% coupon that allowed them to convert the bond into stock if the stock's price rose above a certain value, they might prefer to issue those. The convertible bond may be the best solution for the company because they would have lower interest payments while the project was in its early stages. If the investors converted their bonds, the other shareholders would be diluted, but the company would not have to pay any more interest or the principal of the bond. The investors who purchased a convertible bond may think this is a great solution because they can profit from the upside in the stock if the project is successful. They are taking more risk by accepting a lower coupon payment, but the potential reward if the bonds are converted could make that trade-off acceptable. Zero coupon bonds. Zero coupon bonds do not pay coupon payments and instead are issued at a discount to their par value that will generate a return once the bondholder is paid the full face value when the bond matures. US Treasury bills are a zero coupon bond. Convertible bonds. Convertible bonds are debt instruments with an embedded option that allows bondholders to convert their debt into stock, equity, at some point, depending on certain conditions like the share price. For example, imagine a company that needs to borrow $1 million to fund a new project. they could borrow by issuing bonds with a 12% coupon that matures in 10 years. However, if they knew that there were some investors willing to buy bonds with an 8% coupon that allowed them to convert the bond into stock if the stock's price rose above a certain value, they might prefer to issue those. The convertible bond may be the best solution for the company because they would have lower interest payments while the project was in its early stages. If the investors converted their bonds, the other shareholders would be diluted, but the company would not have to pay any more interest or the principal of the bond. The investors who purchased a convertible bond may think this is a great solution because they can profit from the upside in the stock if the project is successful. They are taking more risk by accepting a lower coupon payment, but the potential reward if the bonds are converted could make that trade-off acceptable. Callable bonds. Callable bonds also have an embedded option, but it is different than what is found in a convertible bond. A callable bond is one that can be called back by the company before it matures. Assume that a company has borrowed $1 million by issuing bonds with a 10% coupon that mature in 10 years. If interest rates decline, or the company's credit rating improves, in year 5 when the company could borrow for 8%, they will call or buy the bonds back from the bondholders for the principal amount and reissue new bonds at a lower coupon rate. A callable bond is riskier for the bond buyer because the bond is more likely to be called when it is rising in value. Remember, when interest rates are falling, bond prices rise. Because of this, callable bonds are not as valuable as bonds that aren't callable with the same maturity, credit rating, and coupon rate. Puttable bond. A puttable bond allows the bondholders to put or sell the bond back to the company before it has matured. This is valuable for investors who are worried that a bond may fall in value, or if they think interest rates will rise and they want to get their principal back before the bond falls in value. The bond issuer may include a put option in the bond that benefits the bondholders in return for a lower coupon rate or just to induce the bond sellers to make the initial loan. A puttable bond usually trades at a higher value than a bond without a put option but with the same credit rating, maturity, and coupon rate because it is more valuable to the bondholders. The possible combinations of embedded puts, calls, and convertibility rights in a bond are endless and each one is unique. There isn't a strict standard for each of these rights and some bonds will contain more than one kind of option which can make comparisons difficult. Generally, individual investors rely on bond professionals to select individual bonds or bond funds that meet their investing goals. Pricing bonds. The market prices bonds based on their particular characteristics. A bond's price changes on a daily basis, just like that of any other publicly traded security, where supply and demand in any given moment determine that observed price. But there is a logic to how bonds are valued. Up to this point, we've talked about bonds as if every investor holds them to maturity. It's true that if you do this you're guaranteed to get your principal back plus interest. However, a bond does not have to be held to maturity. At any time, a bondholder can sell their bonds in the open market, where the price can fluctuate, sometimes dramatically. The price of a bond changes in response to changes in interest rates in the economy. This is due to the fact that for a fixed-rate bond, the issuer has promised to pay a coupon based on the face value of the bond, so for a $1,000 par, 10% annual coupon bond, the issuer will pay the bondholder $100 each year. Say that prevailing interest rates are also 10% at the time that this bond is issued, as determined by the rate on a short-term government bond. An investor would be indifferent investing in the corporate bond or the government bond since both would return $100. However, imagine a little while later that the economy has taken a turn for the worse and interest rates drop to 5%. Now, the investor can only receive $50 from the government bond, but would still receive $100 from the corporate bond. This difference makes the corporate bond much more attractive. So investors in the market will bid up to the price of the bond until it trades at a premium that equalizes the prevailing interest rate environment. In this case, the bond will trade at a price of $2,000 so that the $100 coupon represents 5%. Likewise, if interest rates soared to 15%, then an investor could make $150 from the government bond and would not pay $1,000 to earn just $100. This bond would be sold until it reached a price that equalized the yields, in this case to a price of $666.67. Inverse to interest rates. This is why the famous statement that a bond's price varies inversely with interest rates works. When interest rates go up, bond prices fall in order to have the effect of equalizing the interest rate on the bond with prevailing rates, and vice versa. Another way of illustrating this concept is to consider what the yield on our bond would be given a price change, instead of given an interest rate change. For example, if the price were to go down from $1,000 to $800, then the yield goes up to 12.5%. This happens because you are getting the same guaranteed $100 on an asset that is worth $800, $100, $800. Conversely, if the bond goes up in price to $1,200, the yield shrinks to 8.33%, $100, $200. Real world bond example. A bond represents a promise by a borrower to pay a lender their principal and usually interest on a loan. Bonds are issued by governments, municipalities, and corporations. The interest rate, coupon rate, principal amount, and maturities will vary from one bond to the next in order to meet the goals of the bond issuer, borrower, and the bond buyer, lender. Most bonds issued by companies include options that can increase or decrease their value and can make comparisons difficult for non-professionals. Bonds can be bought or sold before they mature, and many are publicly listed and can be traded with a broker. While governments issue many bonds, corporate bonds can be purchased from brokerages. If you're interested in this investment, you'll need to pick a broker. You can take a look at Investopedia's list of the best online stockbrokers to get an idea of which brokers best fit your needs. Because fixed-rate coupon bonds will pay the same percentage of its face value over time, the market price of the bond will fluctuate as that coupon becomes more or less attractive compared to the prevailing interest rates. Imagine a bond that was issued with a coupon rate of 5% and a $1,000 par value. The bondholder will be paid $50 in interest income annually. Most bond coupons are split in half and paid semi-annually. As long as nothing else changes in the interest rate environment, the price of the bond should remain at its par value. However, if interest rates begin to decline and similar bonds are now issued with a 4% coupon, the original bond has become more valuable. Investors who want a higher coupon rate will have to pay extra for the bond in order to entice the original owner to sell. The increased price will bring the bond's total yield down to 4% for new investors because they will have to pay an amount above par value to purchase the bond. On the other hand, if interest rates rise and the coupon rate for bonds like this one rise to 6%, the 5% coupon is no longer attractive. The bond's price will decrease and begin selling at a discount compared to the par value until its effective return is 6%. The bond market tends to move inversely with interest rates because bonds will trade at a discount when interest rates are rising and at a premium when interest rates are falling. Options. Options are based on the value of an underlying security such as a stock. As noted above, an options contract gives an investor the opportunity, but not the obligation, to buy or sell the asset at a specific price while the contract is still in effect. Investors don't have to buy or sell the asset if they decide not to do so. Options are a derivative form of investment. They may be offers to buy or to sell shares but don't represent actual ownership of the underlying investments until the agreement is finalized. Buyers typically pay a premium for options contracts, which reflect 100 shares of the underlying asset. Premiums generally represent the asset's strike price, the rate to buy or sell it until the contract's expiration date. This date indicates the day by which the contract must be used. Types of options: call and put options. There are only two kinds of options: call options and put options. A call option is an offer to buy a stock at the strike price before the agreement expires. A put option is an offer to sell a stock at a specific price. Let's look at an example of each, first of a call option. An investor opens a call option to buy stock XYZ at a $50 strike price sometime within the next 3 months. The stock is currently trading at $49. If the stock jumps to $60, the call buyer can exercise the right to buy the stock at $50. That buyer can then immediately sell the stock for $60 for a $10 profit per share. Other possibilities. Alternatively, the option buyer can simply sell the call and pocket the profit, since the call option is worth $10 per share. If the option is trading below $50 at the time the contract expires, the option is worthless. The call buyer loses the upfront payment for the option, called the premium. Meanwhile, if an investor owns a put option to sell XYZ at $100 and XYZ's price falls to $80 before the option expires, the investor will gain $20 per share, minus the cost of the premium. If the price of XYZ is above $100 at expiration, the option is worthless and the investor loses the premium paid upfront. Either the put buyer or the writer can close out their option position to lock in a profit or loss at any time before its expiration. This is done by buying the option, in the case of the writer, or selling the option, in the case of the buyer. The put buyer may also choose to exercise the right to sell at the strike price. What's the difference between options and futures? Futures. A futures contract is the obligation to sell or buy an asset at a later date at an agreed-upon price. Futures contracts are a true hedge investment and are most understandable when considered in terms of commodities like corn or oil. For instance, a farmer may want to lock in an acceptable price upfront in case market prices fall before the crop can be delivered. The buyer also wants to lock in a price upfront, too, if prices soar by the time the crop is delivered. Examples. Let's demonstrate with an example. Assume two traders agree to a $50 per bushel price on a corn futures contract. If the price of corn moves up to $55, the buyer of the contract makes $5 per barrel. The seller, on the other hand, loses out on a better deal. The market for futures has expanded greatly beyond oil and corn. Stock futures can be purchased on individual stocks or on an index like the SVEP 500. The buyer of a futures contract is not required to pay the full amount of the contract upfront. A percentage of the price called an initial margin is paid. For example, an oil futures contract is for 1,000 barrels of oil. An agreement to buy an oil futures contract at $100 represents the equivalent of a $100,000 agreement. The buyer may be required to pay several $1,000s for the contract and may owe more if that bet on the direction of the market proves to be wrong. Who trades futures? Futures were invented for institutional buyers. These dealers intend to actually take possession of crude oil barrels to sell to refiners or tons of corn to sell to supermarket distributors. Establishing a price in advance makes the businesses on both sides of the contract less vulnerable to big price swings. Retail buyers, however, buy and sell futures contracts as a bet on the price direction of the underlying security. They want to profit from changes in the price of futures, up or down. They do not intend to actually take possession of any products. Key differences. Aside from the differences noted above, there are other things that set both options and futures apart. Here are some other major differences between these two financial instruments. Despite the opportunities to profit with options, investors should be wary of the risks associated with them. Options. Because they tend to be fairly complex, options contracts tend to be risky. Both call and put options generally come with the same degree of risk. When an investor buys a stock option, the only financial liability is the cost of the premium at the time the contract is purchased. However, when a seller opens a put option, that seller is exposed to the maximum liability of the stock's underlying price. If a put option gives the buyer the right to sell the stock at $50 per share but the stock falls to $10, the person who initiated the contract must agree to purchase the stock for the value of the contract, or $50 per share. The risk to the buyer of a call option is limited to the premium paid upfront. This premium rises and falls throughout the life of the contract. It is based on a number of factors, including how far the strike price is from the current underlying securities price as well as how much time remains on the contract. This premium is paid to the investor who opened the put option, also called the option writer. The option writer. The option writer is on the other side of the trade. This investor has unlimited risk. Assume in the example above that the stock goes up to $100. The option writer would be forced to buy the shares at $100 per share in order to sell them to the call buyer for $50 a share. In return for a small premium, the option writer is losing $50 per share. Either the option buyer or the option writer can close their positions at any time by buying a call option, which brings them back to flat. The profit or loss is the difference between the premium received and the cost to buy back the option or get out of the trade. Futures. Options may be risky, but futures are riskier for the individual investor. Futures contracts involve maximum liability to both the buyer and the seller. As the underlying stock price moves, either party to the agreement may have to deposit more money into their trading accounts to fulfill a daily obligation. This is because gains on futures positions are automatically marked to market daily, meaning the change in the value of the positions, up or down, is transferred to the futures accounts of the parties at the end of every trading day. Examples of options and futures. Options. To complicate matters, options are bought and sold on futures. But that allows for an illustration of the differences between options and futures. In this example, one options contract for gold on the Chicago Mercantile Exchange, CME, has as its underlying asset one COMEX gold futures contract. An options investor may purchase a call option for a premium of $2.60 per contract with a strike price of $1,600 expiring in February 2019. The holder of this call has a bullish view on gold and has the right to assume the underlying gold futures position until the option expires after the market closes on February 22, 2019. If the price of gold rises above the strike price of $1,600, the investor will exercise the right to buy the futures contract. Otherwise, the investor will allow the options contract to expire. The maximum loss is the $2.60 premium paid for the contract. Futures contract. The investor may instead decide to buy a futures contract on gold. One futures contract has as its underlying asset 100 troy ounces of gold. This means the buyer is obligated to accept 100 troy ounces of gold from the seller on the delivery date specified in the futures contract. Assuming the trader has no interest in actually owning the gold, the contract will be sold before the delivery date or rolled over to a new futures contract. As the price of gold rises or falls, the amount of gain or loss is credited or debited to the investor's account at the end of each trading day. If the price of gold in the market falls below the contract price the buyer agreed to, the futures buyer is still obligated to pay the seller the higher contract price on the delivery date. Risk tolerance and your personal portfolio. Many of us would love to manage our own investments, but it can be overwhelming to know where to begin. Do we use stocks, bonds, futures, commodities, or real estate? Should we go long, buy on margin, short a stock, or put everything into CDS? You could, of course, dive into these topics individually, but if you are dealing to manage your own risk, you first have to determine your risk tolerance. From there, you can manage your accounts based on how much risk you want to take on and how much active managing you want to do. Determining your risk tolerance. Risk tolerance is an incredibly important aspect of getting started in investing. Depending on your age, income, investments, and goals, you will fall into one of 5 risk categories. Very aggressive. Aggressive. Balanced. Conservative. Very conservative. The easiest way to get a feel for which end of the spectrum you fall is to go by age. If you're young and just starting your career, you will fall toward the very aggressive side of the spectrum, while if you are older and approaching retirement, then you are likely near the very conservative side. Take a risk tolerance questionnaire to determine exactly where you fall. There are some slight variations, but managing your risk is similar in all 5 categories. Managing risk as a very aggressive investor. If you qualify as a very aggressive investor, you have things pretty easy. Simply put, you will want all of your investments to be in stocks, equities, and none in bonds, fixed income. Some may argue that having a small portion in bonds is essential, but the truth is, you need the most growth to give your account a huge boost while you're young. Having a 100% equities portfolio also means that you are taking on a lot of risk. To manage that risk, most people will put all of their money in mutual funds. These funds are spread out through hundreds of different stocks and minimize the risk of any one company going bankrupt and ruining the fund. For example, take Enron. You could have made a ton of money investing everything in this company, but would have lost everything when they went bankrupt. Mutual funds help minimize single security risk. Keep in mind that you will still want to have a cash equivalent emergency fund, equity in your house, and other non-investment accounts, so you won't truly have everything invested in stocks. Managing risk as an aggressive investor. Similar to the very aggressive investor, as an aggressive investor, you will want to have a large portion of your account invested in equities. However, your account will also incorporate large cap stocks, those companies that are well established and the risk of failure is minimal, and some bonds. The large caps and bonds won't grow as quickly as other equities, but if the economy is in a downturn, they won't drop in value as much either. Your biggest risk here is similar to that of the very aggressive investor. You want to spread the risk around with mutual funds so you don't lose everything in one market downturn. This means that if you have company stock that you have accumulated over the years, it may be time to cash some of that in to redistribute the risk. Managing risk as a balanced investor. Those well into their working careers, but still a decade or two from retirement, will likely be balanced investors. You are done taking substantial risks, and now want steady growth. Your biggest risk is that a huge market downturn, like we saw in 2008 and 2009, could devastate your investments and cause your retirement plans to be thrown off completely. To combat this risk, you need to move into more equities and possibly look at some alternative investments. Changing your allocation to between 40 and 70% equities will minimize a lot of the market fluctuations. When looking at the graph of your investments, the growth will be steadier, but slower than your aggressive counterparts. Keeping more money in cash while looking into real estate and precious metals will help to keep your account at a more even keel than having everything traditionally invested. Managing risk as a conservative investor. When you have a firm retirement date set, you will likely fall squarely into the conservative investor category. You no longer want the risk of losing large portions of your account, but you still need some risk to grow faster than inflation. Your allocation will change to between 20 and 40% equities. These equities will be almost all large cap, and probably those that pay dividends, to keep the volatility down. Your risk profile changes from the risk of losing money to the risk of your account not growing fast enough. Without the aggressive equities, your account grows more slowly, but it doesn't drop as much during recessions. Fortunately, by this period your other life expenses should be minimized, house paid off, school loans gone, kids through college, and you can dedicate more of your income to your investments. Managing risk as a very conservative investor. By the time you are within a few years of retirement, your account should become very conservative. You will want very little risk, and your goal may be to simply preserve your money rather than to grow it. You will have things arranged so you can keep up with inflation instead of growing your account. To essentially negate risk, your account will be up to 20% equities. You will want to have several years' worth of income invested in cash equivalents. A CD ladder is great for this. The reasoning is that you need to eliminate the risk of a 3 to 5 year market downturn. You don't want to draw on your investments when the market is at a low, so during the years it is declining, and subsequently climbing, you pay living expenses from cash savings. When the market has recovered, then you can withdraw funds to replenish your depleted cash sources. Your most conservative years will be the 5 before retirement through the 5 following retirement. During these years, you can't afford to lose money while you figure out your retirement lifestyle and income needs. After a few years of retirement, you can actually start to take on more risk. Keep in mind that by the age of 80 you likely won't be spending as much. The bottom line. How much risk you are willing to take is the key to building a portfolio that will meet your needs, but you can't just assess this once. Every year or two you should reevaluate your risk tolerance. Then, you should continue to adjust your portfolio as necessary to keep it in line with your risk tolerance. Everyone's goals are going to be different, so while these tips for managing risk will work for most people, they won't work for everyone. Some will want to be more hands-on, others will want to be more hands-off. Find an investment strategy that is right for you, then make it a point to base your investments on logic rather than emotion. How to calculate your portfolio's investment returns. The main point of investing is to make money. Although you can't predict how your investment portfolio will do, there are different metrics that can help you determine how far your money may go. One of those is called the return on investment, ROI, which can measure an investment's success. This is an important metric for any investor because it directly measures the return on that investment relative to its cost. To calculate the ROI, divide the cost of the investment by its return. Although it's not a perfect science, this is a crude gauge of how effective an investment performs relative to an entire portfolio. But what if you want to know how well that portfolio will do? Read on to learn how you can calculate its returns. Calculating returns for an entire portfolio. As mentioned above, there are uncertainties that come with investing, so you won't necessarily be able to predict how much money you'll make, or whether you'll make any at all. After all, there are market forces at play that can impact the performance of any asset, including economic factors, political forces, market sentiment, and even corporate actions. But that doesn't mean you shouldn't work out the figures. Working out the returns on individual investments can be a very exhaustive feat, especially if you have your money spread across different investment vehicles that are maintained by a variety of different firms and institutions. But before you calculate your investment returns, identify and gather the requisite data. You'll need to know the following: the total cost of your investments including any fees and commissions, the average return for all your investments. Once you have the data prepared, you'll want to take a few things into consideration. The first thing is to define the time period over which you want to calculate returns: daily, weekly, monthly, quarterly, or annually. You need to strike a net asset value of each position in each portfolio for the time periods and note any cash flows, if applicable. Holding period return. Once you define your time periods and sum up the portfolio NAV, you can start making your calculations. The simplest way to calculate a basic return is called the holding period return. Adjusting for cash flows. You will need to adjust for the timing and amount of cash flows if money was deposited or withdrawn from your portfolios. So if you deposited $100 in your account mid-month, the portfolio end-of-month NAV has an additional $100 that was not due to investment returns when you calculate a monthly return. This can be adjusted using various calculations, depending on the circumstances. The modified Dietz method is a popular formula to adjust for cash flows. Using an internal rate of return (IRR) calculation with a financial calculator is also an effective way to adjust returns for cash flows. IRR is a discount rate that makes the net present value zero. It is used to measure the potential profitability of an investment. Annualizing returns. A common practice is to annualize returns for multi-period returns. This is done to make the returns more comparable across other portfolios or potential investments. It allows for a common denominator when comparing returns. An annualized return is a geometric average of the amount of money an investment earns each year. It shows what could have been earned over a period of time if the returns had been compounded. The annualized return does not give an indication of volatility experienced during the corresponding time period. That volatility can be better measured using standard deviation, which measures how data is dispersed relative to its mean. An example of calculating portfolio returns. The sum total of the positions in a brokerage account is $1,000 at the beginning of the year and $1,350 at the end of the year. There was a dividend paid on June 30th. The account owner deposited $100 on March 31st. The return for the year is 16.3% after adjusting for the $100 cash flow into the portfolio 1/4 of the way through the year. What are corporate actions? When a publicly traded company issues a corporate action, it is doing something that will affect its stock price. If you're a shareholder or considering buying shares of a company, you need to understand how an action will affect the company's stock. A corporate action can also tell you a great deal about a company's financial health and its short-term future. Examples. Corporate actions include stock splits, dividends, mergers and acquisitions, rights issues and spin-offs. All of these are major decisions that typically need to be approved by the company's board of directors and authorized by its shareholders. The stock split. A stock split, sometimes called a bonus share, divides the value of each of the outstanding shares of a company. A 2-for-1 stock split is most common. An investor who holds one share will automatically own 2 shares, each worth exactly half the price of the original share. So, the company has just cut its own stock price in half. Inevitably, the market will adjust the price upwards the day the split is implemented. The effects: current shareholders are rewarded, and potential buyers are more interested. Notably, there are twice as many common stock shares out there than there were before the split. Nevertheless, a stock split is a non-event because it does not affect a company's equity or its market capitalization. Only the number of shares outstanding changes. Stock splits are gratifying to shareholders, both immediately and in the longer term. Even after that initial pop, they often drive the price of the stock higher. Cautious investors may worry that repeated stock splits will result in too many shares being created. The reverse split. A reverse split would be implemented by a company that wants to force up the price of its shares. For example, a shareholder who owns 10 shares of stock valued at $1 each will have only one share after a reverse split of 10 for 1, but that one share will be valued at $10. A reverse split can be a sign that the company's stock has sunk so low that its executives want to shore up the price, or at least make it appear that the stock is stronger. The company may even need to avoid getting categorized as a penny stock. Dividends. A company can issue dividends in either cash or stock. Typically, they are paid out at specific periods, usually quarterly or annually. Essentially, these are a share of the company profits that are being paid to owners of the stock. Dividend payments affect the equity of a company. The distributable equity, retained earnings and/or paid-in capital, is reduced. A cash dividend is straightforward. Each shareholder is paid a certain amount of money for each share. If an investor owns 100 shares and the cash dividend is 50 cents per share, the owner will be paid $50. A stock dividend also comes from distributable equity but in the form of stock instead of cash. If the stock dividend is 10%, for example, the shareholder will receive one additional share for every 10 owned. If the company has 1 million shares outstanding, the stock dividend would increase its outstanding shares to a total of 1.1 million. Notably, the increase in shares dilutes the earnings per share, so the stock price would decrease. The distribution of a cash dividend signals to an investor that the company has substantial retained earnings from which shareholders can directly benefit. By using its retained capital or paid-in capital account, a company is indicating that it expects to have little trouble replacing those funds in the future. However, when a growth stock starts to issue dividends, many investors conclude that a company that was rapidly growing is settling down for a stable but unspectacular rate of growth. Rights issues. A company implementing a rights issue is offering additional or new shares only to current shareholders. The existing shareholders are given the right to purchase or receive these shares before they are offered to the public. A rights issue regularly takes place in the form of a stock split, and in any case can indicate that existing shareholders are being offered a chance to take advantage of a promising new development. Mergers and acquisitions. A merger occurs when two or more companies combine into one with all parties involved agreeing to the terms. Usually, one company surrenders its stock to the other. When a company undertakes a merger, shareholders may welcome it as an expansion. On the other hand, they could conclude that the industry is shrinking, forcing the company to gobble up the competition to keep growing. In an acquisition, a company buys a majority stake of a target company's shares. The shares are not swapped or merged. Acquisitions can be friendly or hostile. A reverse merger is also possible. In this scenario, a private company acquires a public company, usually one that is not thriving. The private company has just transformed itself into a publicly traded company without going through the tedious process of an initial public offering. It may change its name and issue new shares. The spin-off. A spin-off occurs when an existing public company sells a part of its assets or distributes new shares in order to create a new independent company. Often the new shares will be offered through a rights issue to existing shareholders before they are offered to new investors. A spin-off could indicate a company ready to take on a new challenge or one that is refocusing the activities of the main business.